At the same time, we have been cautious on the infrastructure sector for a long time because of lack of policy clarity, and therefore we have kept ourselves much more focused on sectors other than these three in terms of our lending approach. Combined with that, we also saw that there is a possibility of a change in government post-elections. So it was clear that there is a potential of a government change, and therefore India is back to my favorite statement that you got to look at the India story as a movie and not as a photograph. And if you take that position, you have, this was 2013-14 was a great period to build what I call as capacity. And therefore a lot of our steps in 2013-14, including our current decision, is linked to our desire to build capacity. So that when the opportunities for faster growth come, and in other words, when Achhe Din become real, we have got enough capacity to grow faster. And therefore, in that context, you can look at our thinking for the future, which we have identified in our annual report right here in front of you, which is we are building capacity for the future so that we can be a bigger, bolder, better Kotak. Clearly, the way areas which we started focusing on a lot more was primarily what we call as working capital cycles for companies. Significantly higher focus on small and medium businesses. A reasonable focus on what was in a way finding segments and pockets across sectors which were less hurt. For example, we increased our focus on export companies. So you have to shift your engine in the direction of what you think is sustainable business for the future, and which is not going to lead you to significant challenges on the balance sheet. And I have always believed, and I've said this publicly as well, that the balance sheet of a bank is far more important than its current P&L. If you look at, obviously there's a pattern in the way we have been approaching things in the last 2 years, if you look at it from today's perspective. And the key pattern is, first, that we are taking steps to build capacity. Therefore, if you look at our capacity on capital, we've got significant capital. Therefore, even for our own organic growth and now even inorganic combined, we have enough capital in our tank. So that is the first major step we have taken for ensuring that we are building capacity. Second is a relentless focus on the liability side of the balance sheet, which is deposits, we grew our savings deposits last year just below 40%. We grew our retail deposits below 1 crore at between 30 and 35%. It was all towards a clear focus on capacity building on liability. And therefore, even the inorganic moves are consistent with that philosophy. When you look at our NIMs, our focus on the whole business of lending is very risk-adjusted returns. Therefore, whenever we do a lending, we look at it much more risk-adjusted. Therefore, for the risk we are taking, we must make enough spread. So that is one philosophy. The second important philosophy is that as we do our mix of lending, there is an element of retail. When I say retail, I mean small loans below 5 crores, which are nearly half our balance sheet. Now, when you do smaller loans, your fixed cost to income is a little higher, but your spread is larger. So our NIMs look larger, but that is reflected to a certain extent in a slightly higher cost to income.
The cost is higher, you mean to say, for small ticket loans?
Because there's more people, documentation, transaction costs, people costs. But smaller ticket loans make larger spread. So that reflects in our NIM. And higher fixed cost reflects in our cost to income. So our higher NIM is also coming at a slightly higher cost to income ratio. So if you look at HDFC and ICICI, our cost to income is a little higher, and there are various reasons. One of this is that. And second is we are adding branches as a percentage of the base faster. So there's a higher fixed cost for branches which before they become profitable. See, an average branch on a marginal basis, fixed cost included, costs in metros about 2 odd crores. And in other areas, therefore overall if I take as a network, my average is between 1.5 to 2 crores. We don't own branch properties. And rentals keep on increasing too much. Now we will be more measured. And the good news is RBI licensing is freed up. So this is a good fit and saves time to market. The size is going to be an important aspect, not the only aspect for the future. And to a certain extent, I think you also got to keep in mind that the bank went through very big challenges on its asset side when ING first came in.
We're talking about that bank. Yes, correct.
So ING came in and had a significant challenge in cleaning up, managing people, culture. All those issues have been challenges which they have faced, and I think some of them they have done a good job at. And Indian environment is not an easy environment to manage. You know that. We have to take a path to growth, na? So step by step. This is a staircase, yeah.
I know.
And we will grow up. Now with the larger base, we can grow significantly more organically, no? This gives us greater capacity to add liability. This gives us greater capacity to push through product. I mean, I've given one example on my analyst call. We are the largest bank lending in tractor financing. ING Vysya is not into tractor financing. And they have such a rich network of branches in the south, particularly Andhra and Karnataka. So we would love to see the tractor financing product as an example, which we can have it distributed through ING Vysya Bank branches. And if the economy starts recovering, then this capacity which we create together and all the products, commercial vehicles and other products, we can really broad base it across the nation, which otherwise was on our network. And as we grew our network, now we will fast forward it. If you look at our breakup, we have 46% in the west, 34% in the north. Therefore, on a combined basis, 80% of our branches are in west and north. And ING Vysya, 65% of the branches are in the south. So we had our presence in the south was 15%. So we were 46, 34, 15, 5. They are 65% south. So just look at the distribution complementarity and our capacity, back to building capacity to be able to distribute product across the country. So it's back to the strategic theme, organic or inorganic. Build capacity for a marathon. We see a marathon ahead in terms of the economic growth sustainably growing over a long period of time. We may have right now we may be in the period of a slowdown, but we think we are probably in the bottom of the cycle. Gradually, as the economic growth picks up over time, we must have the capacity to be able to finance that growth for the country. And obviously it means for our stakeholders. See, our view is economy will be gradually going up. We don't see a hockey stick, but we don't see the economy going down. Our view on the economy is positive but gradual. Therefore, if you had asked me, my view for this year growth is around 5.5%, not more. Could be a little lower as well. If I have to take a 5-year average view of Indian economy, my view is 6.5%. So if the economy is gradually going to move up, we want to make sure we have capacity for that growth. And we also see at the same time in the banking sector, significant challenges faced by a number of banks, both private sector and public sector. Because both of them, there is a certain bogging down due to the stress assets on their balance sheet. On the other hand, we feel confident that this is a time where if there are good accounts, we are ready to acquire those good accounts and grow them. So because of our cautious approach in the earlier periods, we now feel we are in a position to really take things forward, as some of our competitors are still battling with history. I think my view is, unfortunately in India, banks have been focused, including from the private sector, too much on their quarterly P&L and much less on the need for having high quality balance sheets. So first, balance sheet has to be the core of measuring how a bank will do in the future. My view about banking is very simple. The first compulsion any bank has is an obligation to make sure that the depositor's money is safe. Every other compulsion is subservient to this fundamental compulsion: protection and safety of the depositor's money. And in an institution where leverage is at least 10:1, the room for making mistakes is limited. Assuming you have 10 rupees equity, as a bank you are allowed to borrow 100 rupees deposits, that is debt. So totally you got 110. You lend the 110. You lose 10, you go home. But it is a fact. And therefore that the first dharma of a bank is to make sure that you remain solvent and have a good balance sheet. This thing about wanting to please analysts with quarterly good numbers while putting it under the carpet in your balance sheet is something which is very, very problematic in my mind. So I'll just give you the example of Bangalore. We are at 20 branches. We love the 40 branches they add, so we get to 60. In Bombay, we are 90, they add 35. So we are happy to go to 125.
Okay.
So there is no overlap, or very minimal overlap, virtually zero. In the short run, as long as the Indian economy has so much of a cash economy where branches are needed, I think the size of the Indian economy for us, 1200 branches does not pose that challenge. But there will come a time, 5 years from now or 7 years from now, when you and I will be sitting, if people who have got 3 and 4 and 5,000 branches, do they need so many?
The debate will come on then.
That is 5 years from now. But 1200 for a country of India's size,
It's
manageable. Therefore we are clear that we don't want to be 5,000 branches. We are clear. Because that at some point of time will become baggage.
Right. Yeah.
But 1,000, 1,200, 1,400, 1,500, not certainly manageable and required. And again, you're dealing with two eras. Next 5 years, branches are still needed.
You need the presence.
But next 10 years may not be to the same extent. So we have to live for the next 5 years and the next 10 years. Therefore, in a way, having not a very big network, but a decent network is the best spot to be. So there are about 10,000 employees, and we are very committed to make sure that the combined employee force is our force. I mean, we want to build a complete commitment to ensuring that all employees are treated fairly and equally across the two banks. If you look at our view, is banking and financing, if you look at for March 14, was about 83% of our total business. 84%, I think. Banking and financing was 84%. Capital markets was 6%. Asset management and life insurance was 10%. So between asset management, life insurance and capital markets, including investment banking, it was about 16%. Our view about a fair balance is 75-25. Instead of 84-16, 75-25 is what we see the future. This is before the merger of ING Vysya Bank. Whatever that changes the ratio, it will take it back up.
Yeah, it will probably be more favorable to the numbers.
The banking and financing, it will go back up there.